The strategies and concepts discussed are for educational purposes only and do not represent specific investment, tax, or estate planning advice. Investing carries an inherent element of risk, and it is possible to lose principal and interest when investing in securities. No strategy can guarantee a profit or prevent against a loss. The views expressed represent the personal opinions of the presenter or the featured guests, not necessarily those of USA Financial or its affiliated subsidiaries. Any opinions or forecasting statements are subject to change at any time and without notice. John Cyndia is an investment advisor representative of, and advisory services are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. Life Stages Advisory, Dean, and Remington are not affiliated with USA Financial Securities. Welcome to episode 57 of Wealth, Tax, and Finances. I'm your host, John Cyndia, certified public accountant and personal financial specialist. Today we're going to talk about Financing 101. We're going to tear it down to the basics and look at financing just about anything with a different viewpoint here. Because most of the time, if somebody goes out and looks at something, they're going, well, I've got a small interest rate. I can finance that for X period of time, like say on a car. They've gone from 36 to 48 to 60 months, and now they're 72 and 84 months and 6, 7, 8 years down the road, and little or no interest or whatever. And somebody else says, well, I might have a mortgage, but I want to pay extra payments on that, and I want to do this, that, and whatever. I want to show you where you need to be efficient with your money and make sure that what you're looking at and how you're looking at it is going to be, it's going to put a little bit more time and effort on your part to think about this stuff, because there's something that we're going to talk about that's an opportunity cost, and which basically means if I buy this, what am I missing if I would not have bought that item or saved my money? Or could I have saved in a different manner? And look at it from a perspective also from income and expense. So a lot of times people are saying, well, I just need to make more money to keep my current lifestyle going. And they don't want to look on the expense side and say, well, this is really inefficient. If I spent less here, I would have more money and I wouldn't have to earn more. Or if I wanted to save more, could I look at inefficiencies in how I'm either spending or currently saving? So we're going to hit on a little bit of each of those items today. And hopefully by the time we get to the end of this, it's going to make you think a little bit more intently on exactly how you need to look at spending your money and where you're putting your money to work, and things like that. So let's get started here. Okay, you finance everything you buy. In other words, sometimes if you save something and you pay cash for a car, that's pretty much called self-financing, because you saved up $10,000, you bought the car, now you drained, on what we're looking at here, you drained this safe tank from your savings, and you didn't borrow any money. You said, I hate debt, whatever, and you have to start saving again. So if you look at it, you either borrow from a lender and pay interest, okay? You look here on a red tank to the right is for people who are listening on the podcast and are not on YouTube. I suggest you go to our YouTube channel so you can see this a little bit more colorfully and graphically oriented here. But on the left-hand side for the podcast people, there's a safe tank and a savings. And you have on the right side is a liability in a red tank, okay? Now, if you turned around, you either borrow from a lender and pay interest, or you save interest like I mentioned before by paying cash, but you lose the interest you would have earned had you not drained the tank, okay? So there again, we have an opportunity cost. So if we pay cash, we're not earning anything. And if you remember from our last episode about the Super Roth that I discussed, about the compounding effect of interest. So what you don't want to do is to save a bunch of money deplete that because you wanted to pay cash for something, you're interrupting that compounding effect. That's what we want to avoid. So if we turn around and decide you're going to pay cash rather than borrow money from a bank or a lender and keep your safe money compounding, that's the opportunity cost. What am I going to lose if I do this rather than that? So you need to look at things in a different perspective here. So let's illustrate here. We're going to have initial cost of, say it's a car, financing rate of 5%, 60-month term. Calculated payment is $566.14. We're not making any extra payments. And the opportunity rate, in other words, what we would lose if we didn't have that, would be 5%. Okay. So you have $30,000 saved in your tank and you need to make a purchase for that same amount. If you earn 5% interest in your tank and the lender charges 5% interest on the loan, you're looking at the results over a 60-month period, $566. So let's look at a couple things here. You could pay cash, which would require you to drain your tank. Your safe tank has $30,000 in savings. Draining your tank resets the compounding effect. Now remember that. So if we have that $30,000 in there and all of a sudden we turn around and we're not utilizing that tank again, we're having to reset all over for that compounding effect to start. If we turn around and have a liability of $30,000, we borrow this money. Your money is earning interest yet in your safe tank because we haven't utilized it. You're using what they call OPM or other people's money. You're paying interest, but you're maintaining control. So this is where a lot of people have I guess they have an objection to this type of thinking when it says, okay, I have $30,000, but I want a car. I pay the car off. I have no cash, but now I've got a depleting asset in that car. They feel good because they don't have the liability. To me, I would much rather have my $30,000 cash that I would have and borrow that money. Obviously, with favorable rates, we're not going to do it with a credit card, but if we have something around 5%, as in this example, it makes, I think, a lot more sense to be in control and saying, what am I going to have? Now, you see here on the YouTube that as the payments are being made, the liability is going down, but my safe tank is going up because I still have my money. And this is where some people think that, geez, because I saved money because I didn't have to pay the interest on that car, but in actuality, you have to figure out on the example here, you paid back your car, $30,000. You had interest on that of $3,968, but the interest you lost was $4,533. In other words, that cost of the car, of you financing it and losing the money that you could have had you paid cash, is $38,501. So there really isn't any benefit if the interest rates that you would have earned and the interest rate that's going to be charged for that loan are the same. Okay, now I'm not talking about arbitrage and saying, well, I could have borrowed at 2 and I saved at 5. Well, obviously you wouldn't pay cash at that point. Or if it was a situation that you were only earning 2 and you're going to pay 5, it's going to be offset. This is if you were giving up 5% opportunity to earn on your money and had a 5% loan, all things being equal. So if you look at it from that standpoint, you're not any farther ahead by borrowing money or paying cash. So the people who say they pay cash and are saving money, it's pretty much an incorrect statement. So this shows you exactly what types of situations you have to sort of think about and start looking when you're dealing with financing in general. Okay, if you made an extra payment of $200, there's no effect on the total cost, because if you would turn around and make the extra payment, you have less interest for that portion of period that you would have paid, but you also have that much less that you would have earned in interest because you're accelerating that payment. Now you don't have the ability to earn on that money. So it's just a total offset. And other people sit there and think that that's not the case, and be able to pretty much prove that empirically here. Now, financing rate, like I was talking about, if you had 1.9% and your lost opportunity rate was 5%, then you could see here where paying it in full from borrowed funds would be $36,000. You kept your money in your tank, it'd be $38,501. So obviously, if you have a lower financing rate, you would definitely want to leave your cash in the tank and be able to use that arbitrage and be able to go that way. Flipping it around, the financing rate's at 5%, the opportunity rate is 1.9 to earn. Now all of a sudden it makes more sense to possibly pay cash for that, because your safe tank would have $32,987. You would have paid $34,864 in there. Now there again, it looks like off the top of your head that would make sense, but you're still in control because you still have your cash. So there it's going to come down to personal preference. I don't like to look at everything as just being numbers, but it's a situation of, do you want to be in control of your cash, have that done, and is the difference of about, $1,800 insignificant for you to pay an additional $1,800 but still have the utility of $33,000 at your disposal? Those are things you have to think about. But at least I want you to start thinking that there is some arbitrage opportunities, but if it's an offset, that you're not farther ahead by paying things off, as most people would want to believe. So it doesn't like paying interest, likes earning interest, must drain the tank, killing the compounding. That's what happens when you don't borrow the funds and you pay cash for everything. So I think there's a lot of things to be learned from that. And, hopefully you understand what's going on with the situation here. What we're looking at now is the fact that they drained a tank to make the purchase. They lost control of all their purchasing dollars, and they lost the interest account was earning. So the payment is being made to yourself to replenish your $30,000 that you paid in cash for that. You lost $8,501, okay? So when you start looking at the comparison of the cost of the purchase versus the future value of the tank, you're still back to this control situation. So do you want to pay by cash? Is it better to borrow the funds? Or is it a situation of just being in control of your money? So I think you really need to sit down, figure out what it is that you're comfortable with. Things to consider here. Assuming you're in the same rate of interest you'd have to pay if you borrowed, the cost will be the same, like I said before. Paying cash drains the tank and resets the compounding, okay? If the money in your tank could earn more interest than cost to borrow, consider the opportunity cost of draining your tank plus giving up control. That was when I was showing the difference between a 1.9% rate and a 5% rate. And we switched those two to whether or not you were going to earn an interest rate or if you were going to be paying interest on the loan. Maintaining control of your money may even be worth paying higher interest. That's when I was saying, is it a situation that I still have $33,000 in my control, and am I willing to pay that $1,800 of additional interest? So there again, it's all control, and it's what is more effective and makes more sense when you're starting to work with money efficiently, okay? If it costs more to borrow than you can earn, perhaps you should consider other tank alternatives. In other words, instead of a safe tank or a savings tank, do I have an investment tank? Okay. Do I have something, it could be your 401k to borrow out of? What's the rates on that? Is it a situation that I have a regular non-qualified brokerage account? Should I utilize something out of there too? So many different options that you have that people just don't consider when they're looking at buying things. Okay. And like I say, finally here, the paying cash is financing. It's just self-financing. Okay. So I think when we start looking at things like that, Dean and Rem are here in the studio, so I wanted to go back to them and say, hello.
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 Hey, how you doing? How's it going?
Just in a general facet, I guess, have you guys thought about really when you're buying a car or anything?
I just did that.
You did?
Not too long ago.
And what did you do?
Well,
use other people's money?
Well,
did you pay cash?
No, I didn't pay cash. I don't have the money to do that. I know we talked about it before, but my credit was basically non-existent for the longest time. So I finally got that squared away, but I took out a loan and I just let them take full control because I had no idea what I was doing.
Okay.
I mean, we talked about it before, but the previous situation I was in, it was in terrible spot where I was paying so much money on my car to where because I was on my parents still. So I switched over. I'm saving a bunch of money, but I really just let them do most of the heavy lifting. So I went completely blind into that situation.
Yeah, I think the spending the big loads of cash, I don't know if that's really in my lifetime what I've seen is just people much older than me doing things like that. Dumping out part of their savings on a car. And maybe it is the in control thing and not wanting to have a monthly payment. Maybe they're just not really worried about the fact that pulling that money out of their savings, they're technically losing because of the, and especially when you're in your older ages, rates are so good. Your credit can be so good that even at some points, you could have 0%, depending on where you finance from, where you finance through, whether you lease, whatever it is, that it might be, just in terms of vehicles, cars, might make more sense to even finance in that case, even if you do have the money to, shell out on a $30,000, $40,000 car, whatever it is that you're buying. But no, I've always financed all my cars. I would never even consider saving up money just because I know, just on the fact that the depreciation value of a car, I'm going to lose money if I shell out just per se 30 grand on a car and I keep it for 10 years, depending on what kind of car I bought, it might be worth money, but it's going to lose.
Don't they say like if you buy a brand new car, like the moment you drive off the lot and if you were to bring it back, it like depreciates. You know what I'm saying? Like I feel like there's a certain percent or something.
You're certainly losing money when you pull off the lot, but just in terms of between financing and saving, I've just with the rates that you can get, I just think it makes more sense.
Well, in the example that I went over there is, like 5%. But what you're not taking into consideration is the factor that I'm giving you, if I pay my cash for a car, I'm giving somebody $30,000 today. So I'm giving you $30,000. If it's financed over 6 years, and say you got even a 2% inflation rate, okay, if I pay that over a 5-year period, that's 10% less. Those dollars are going to be worth 10% less when I give them to you in 5 years. So if I would rather give somebody cheaper dollars, so I would get to keep the more expensive dollars. So if I've got $30,000, I'm keeping $30,000. And if that payment is $500 a month, by the time I get done paying it, it's the equivalent of me only paying about $450, in that
with
last
inflation,
year.
you're basically gaining money.
Exactly. So, and what am I doing? Well, then I'm still not interrupting that compounding effect, whether it's a stock, whether it's, you're not going to get any savings, but say you ended up earning some type of a bond or whatever was making 3-4%. I haven't interrupted that. And there again, it's that opportunity cost of what's that difference. And people, they always say, well, I paid cash, I saved all that money. Well, no, because you lost the opportunity to earn the interest you were earning or whatever that was doing. So, excuse me, the point I wanted to make there was the fact, if you think about it, it's not helping you to pay anything down any faster. So if you do have that ability to arbitrage, and I'm making 4 or 5%, I definitely don't want to pay cash if I can finance it for 1.9 in that example. Okay? So why would I give you money when I'm going to lose 3% on the difference of that, by just hanging on to it? So it's a control factor, but it's also sort of a smart money situation at that point. And I think that, not only from the opportunity cost standpoint, but you have to look at it from an efficiency standpoint, because there again, when you start saving, everybody is trying to earn more money. Because say they save $10,000, but they say, I need to earn, a 6% rate. Well, if we're only looking out there at 6% and you can only earn 3%, what are you going to have to do? Well, I have to either earn more to get up to where I can, I have to save more, okay, in order to maybe earn more from that standpoint, but I can't find anything that's going to give me 6%. If I turn around then and say, geez, I don't need to spend this, whether it's coffee in the morning or it's a Netflix account or whatever, but I could save a percentage of my salary, say. I'm getting paid $3,000 a month. Well, if I could save 1%, what is that? That's $30. $30 times 12, it's $360. And, what's that equate to what I could earn, on my money? Maybe I could actually earn more by spending less. I don't know if it's a little concept I can get into next time a little bit. It's called circle talk. We're going to talk more in circles about what it is, but I think I can show it to you better from a graphical standpoint. We can probably hit on that the next time or in a future episode. But you don't always have to try to earn more on your investments. You can save by reducing your expenses to get to your same savings goal. So I might not need to earn 6% on my investments to get to my savings goal that I'm trying to hit. So I don't need to have my money work harder all the time. I can actually save by not spending as much and putting that lack of expense into my savings. So it's just a different way to look at it. Same thing with mortgage in a house. I've got friends that they're trying to pay off the house faster, so they're paying an extra $500 to $1,000 a month. Well, they still don't have enough money to retire. And I look at it a little bit differently, saying, okay, what if you didn't have a house payment? You're not going to live out in the middle of a field. You're probably going to rent something. Okay, so what is that rent going to be? If I'm paying $1,000 a month for a house, I'm not going to go and rent something for $300 a month. I'm probably going to have a decent rental property that I would have, and I'd probably be paying $800 to $1,000 a month.
Similar to what you're paying for the house.
Exactly. Yeah. So what's the difference there? I could be 85 and renting. I'm still going to be paying $1,000 a month. So why would I want to turn around and pay my house off if I'm financing something at 2.5% or 2% now? Why would I want to accelerate and pay a $250,000 to $300,000 mortgage when I could turn around and keep that $300,000 in my bank, and there's my control? It's just on a larger scale than the $30,000 car. Okay, So you could pay it off. I'd rather have the $300,000 and utility of that and say, what can I earn on it? I don't know if I earn 3, 4, 5%, whatever that is. The fact is I got $300,000. And I've had people before that would turn around, pay a house off, and have depleted all their money. And all they've got is their cash flow. So the ironic part is that as soon as they would have an incident come up, like a furnace go out or an air conditioner or something, they need $5,000-$6,000, they got to go to their credit card. To me, that's just sort of crazy, because that would be something that I would turn around and pay cash for. But they don't have the cash now because they just paid their house off.
Right.
So, at some point, if you had $1 million or $2 million or $3 million and a $50,000 lifestyle, maybe it's not going to make that big of a deal. Okay. You pay off $50,000 loan or something, and you still got $1 million too. There again, you're still in control of the majority of your money. I've had people that just said, well, it's a nuisance, making the payment. Anytime I get a chance to use other people's money or from, that's at a decent rate, I'm going to do that.
That's what I was going to say. I think the part of it might be maybe from the past when rates weren't so good. So yeah, it might have made sense, 10, 15, 20 years ago to buy a $20,000 car outright, because you might go to the bank and get 10, 15, 20% interest rate.
Oh yeah. Yeah.
So back then, that might have made sense, but now,
well, here's the other thing. With the tax laws having changed in the last few years and the standard deduction having gone up, less and less people are being able to itemize. So now all of a sudden, somebody that was utilizing when rates were 5, 6, 7%, and Uncle Sam, say you're in a 30% tax bracket, and you've got $10,000 worth of interest, okay, and you were able to take that out. Uncle Sam picked up $3,000 of that at 30%, tax rate. So now all of a sudden, if you were paying a 5% interest rate, and Uncle Sam was able to kick in 3,000 of that, now that took your net effective rate maybe down to 4.5 or 4.25. Makes sense. But now all of a sudden you've got 2.5% interest rates. You can't deduct that. Some people might say, well, then it makes sense for me to pay the house off. You're not having any effect on it. You got low rates. To me, it's more of a case that, you've got that positive cash flow. Keep it going. I still wouldn't turn around and pay that off. You're not getting any benefit. So you have a raw 2.5 to 2 or 2.5% rate on your money. There's no tax effect to help you out, but you're still, you're paying very little on the interest rate. It's some people just can't see past that, and to me, I can't see not using somebody else's money. I'm just not going to accelerate, to pay that house off. I just don't see it. You can always do it. I've always had people, argue the case with me, but, when you're turning around and upside down, if you feel comfortable and you've got $500,000 or $1 million, you want to pay it off, and it's a couple $100,000, $200,000-$300,000, and you're never going to spend the other money, and you're safe because you're not a spendthrift. You got a lifestyle that's within your means, then I guess that's up to you.
I think it's a different story when you're depleting the whole deal for one thing.
Yeah.
That's different. Like you said, you're gonna have to use credit cards for emergencies and things like that.
Yeah, but it's just seeing that, and then I still see people that turn around and they'll want to pay cash, and then they still go through more money, and all of a sudden that $40,000 lifestyle becomes $80,000. Now they don't have any money. They got they're going to have to borrow off of the house. Nothing wrong with that if you have a way to pay it off or to make your payments. But then, you don't want to get into a situation you pay your house off, then have to turn around and take a line of credit, spend all the rest of your money because you thought everything else was okay. And, I've seen that, people didn't have enough money to turn around and pay the loan to get the line of credit. Now all of a sudden they don't have any money. So now they got to sell the property. So, there's lots of things out there, and it's just crazy how people think. And I think it's important to just sit down and, discuss it and get some common sense out there that says, hey, what do we really want to do? And I think when you're looking at it from a standpoint of paying an asset off before you retire, and you don't have enough savings to retire on in a comfortable manner, then I think you need to try and start putting more money away before you start thinking about paying that big, paying the house off, especially if you're looking at several $100,000 going in on something. To me, it just never made a whole lot of sense, because you'd be doing something. Like I said, if you didn't have that house, you'd be paying rent anyway. So you're always going to have some. I figured that most of the time I'd have either a car payment or a house payment, maybe both.
Maybe none.
Maybe none. If you had bunches of money. So, anything else you can think of from that aspect?
No. I think this is very, very helpful to kind of like see it.
Just to sit there
visualize.
And so I think going forward, some of these apps we'll have on here, we want to hear the comments. And for the first 3 that get in with comments about this episode, or if anything was helpful on this or something else that you'd like to see, put us in the comments section. The first 3 will get a WTF t-shirt.
They got to email us their info, though.
And
what's
email
that email?
us. And that, I'm glad you asked. That email is jcindia@lifestagesadvisory.com. So that way we'll have your information so we can send that out. Like us, love us, make sure that you're telling your friends about us. We always love to hear comments and real life situations. If we can help you, email us. And till next time, what do you think, guys?
Yeah.
We'll see you later.
We'll see ya.
See ya. Thanks. Bye-bye.